Good morning, dear students. Very good morning, Ankit, Hariharan, Kripa, Uma. So, I welcome you to this session for revising the concept in topic of portfolio management, which pertains to CA Final Paper 2, which is Advanced Financial Management. Now, in this session, we are going to revise the concepts of portfolio management, and also we'll be doing quite a few number of numericals to look for the application of the same. Okay, so let's first quickly recap all the concepts that we have, the topic of portfolio management, quickly with certain expressions, certain numbers, and then we will take up the numerical questions. Okay, so now let me begin with the initial aspect. So we know that this chapter has got a good number of technical formulae which we need to remember before we go for the exams. Most of them are quite logical, and certain formulae we just need to accept it as the words of God, because we may not be in a position to understand the derivation of the logic for that for the time being. So to begin with, calculate something called as the expected return. Calculate the expected return of a security. The expected return of a security is calculated as summation of x upon n, or summation of probability into x. Okay, where we know x is equal to return of security in the history on anticipated range. Okay, so if you are having data regarding last 10 years return, you just simply take the average of all those 10 returns. Or if you are creating probability scenarios, then those probability scenarios will be used for calculating the weighted average number. That's your expected return. Then expected return obviously cannot be looked upon in isolation, because we also need to check, along with the expected return, we need to check the risk of a security. So risk of a security, is calculated as standard deviation of security. Standard deviation of the security is calculated as square root of summation of x minus x bar square upon n, or if it is a probability based scenario, then it is going to be square root of summation probability into x minus x bar square. Okay, the risk of a security, we say it's going to be square root of x minus x bar square the whole upon n, or summation of probability into x minus x bar square. Now, after having seen the risk and return of individual securities, now we will look at what's the risk and return for a portfolio of security. Okay, so expected return of a two security portfolio. expected return of a two security portfolio. That's going to be square root of weight of x square into standard deviation of x square plus weight of y square into standard deviation of y square plus 2 into weight of x, weight of y, standard deviation of x, standard deviation of y, and correlation between x and y. Okay, so that's your expected return of a two security portfolio. We can also combine these three terms and say that this is same as the covariance between x and y. Okay. And of course, before we go to the further aspects, we need to also see how do we calculate the correlation between x and y. So the correlation between x and y can be calculated as covariance between x and y upon standard deviation of x, standard deviation of y. Or you can further simply expand the formula and you get this as summation x minus x bar, y minus y bar, the whole divided by square root of summation x minus x bar square and square root of summation y minus y bar square. Alternatively, you can also say this is n summation xy minus summation x into summation y, the whole divided by square root of n summation x square minus summation x the whole square, and then again square root of n summation y square minus summation y the whole square. These were the formula for correlation. Okay. And if you have like the probability scenario, then it goes like summation of p into x minus x bar, y minus y bar, the whole divided by square root of summation p into x minus x bar square and summation p into y minus y bar square. So that's the correlation between x and y. Okay, so that's your portfolio management. Okay, so portfolio management, initial part, we can say expected return of security, risk of security, as well as expected return of a two security portfolio. And this is expected risk, this is risk of a two security portfolio. Now, return of a two security portfolio. Return of two security portfolio is rate of x into average or expected return of x plus rate of y into average or expected return of y. Okay, so these are like uh, the portfolio risk and return. If we have got this as three security portfolio, then we'll have one more term pertaining to z, which is weight of x standard deviation of x square, weight of y square standard deviation of y square, plus weight of z square into standard deviation of z square. And then we will have like these three terms. One is, of course, correlation between x and y. Another will have a correlation between x and z. And the third one will have a correlation between y and z. Okay. So that is about the risk and return of portfolio. Now, after that, we create the possibilities of the portfolio risk and return with respect to various weights. And what we get is a chart or a group graph like this. Okay, so here we have the risk, and here we have the return. Okay, so this is like a chart that we create. So initially you are positioned over here. Then as you keep on combining securities into your portfolio with greater weightage, as you keep on combining securities into your portfolio, what we observe is that you initially face a reduced risk with an increased return. As you move behind, as we keep on combining the other security in our portfolio, and that the risk reduces and the return increases. So this set of portfolios, what do we name this set of portfolios as? What are these set of portfolios? What do we call them? Are they efficient portfolios or inefficient portfolios? This series of portfolios is. These are the inefficient portfolios, right? Because this set of portfolios are actually not making any sense for investment. It doesn't make any sense for investment. These are inefficient portfolios because if you are sitting over here, let's say at position A, it's better to shift to B because B is offering you a higher return at a lower risk. Same way, if you're sitting at B, it's better to shift to another position C, which is going to give you higher return at lower risk. And same way, it's better to just keep on shifting up to this point where the shape of the curve changes from concave to convex, right? So these set of portfolios from A to, let's say over here, D, those are the inefficient portfolios. Those are inefficient portfolios because they actually doesn't make sense for a rational investor to be invested in those portfolios because they are not going to provide you a better risk return combination. So none of the investors would be interested in creating these portfolios. Rather, all our investors will be at least be sitting at this point D or beyond that. So if let's say the person who is sitting at the portfolio A, he wants this level of risk. So for this level of risk, of course, why should he be accepting a lower return? When he can get higher return. This guy A is definitely going to shift to the upper part of the curve. Same way B will shift upwards, C will shift upwards. So all those investors sitting on this inefficient portion are going to shift to the upper part. And ultimately, what will be left out in the market is going to be a collection of only efficient portfolios or efficient securities. And what is this line called as? The collection of all the efficient portfolios or securities. What is this curve called as? What's the name for this curve? Yeah. What do we call this curve as? Which is a collection of all the efficient portfolios. Yep. This is called as efficiency frontier. It's called as the efficiency frontier because this is the frontier. This is a collection of all the portfolios which are efficient. Now, when do we say that a particular portfolio is efficient? Or when do we call a security to be efficient? Efficient security, first we say there is no security, or I can say there is no other security with higher return at lower risk. Second, there is no other security with higher return at same risk. Third, there is no other security with same return at lower risk. Okay. These are the efficient securities. If you want to call any security to be efficient, it needs to be fulfilling any of these conditions. In fact, it needs to be fulfilling all these conditions, not any of this. So there should not be any other security which gives a higher return at lower risk. There should not be any other security which gives you a higher return at same level of risk or same return at a lower level of risk. Right. So here you can find this efficiency frontier is fulfilling all the three conditions. Because if you have a security, let's say over here, so this security is definitely inefficient because there is another security over here, another security over here, which gives high return at same risk. Then we have this security, yeah, which gives same return at lower risk. And if you look at any other diagonal, you have this as high return at lower risk. So in either of case, this particular security is inefficient because all other securities on that efficient frontier are providing better terms. Okay. So this is what the efficiency frontier is. Then comes the founding member of this portfolio management theory called as the Mr. Harry Markowitz. Now, this guy, the Nobel Prize winning Harry Markowitz, he came up with this concept of portfolio theory, this proposition with regards to the types of investors that we observe in the market. So Harry Markowitz said that there are three types of investors that are available in the market. So three types of investors include: first is the category of investor who just would like to take risk, the risk lover. Second is the risk neutral, who is not concerned about the risk but only the return. And the third is risk averse. The risk averse is the investor who would like to take risk, but uh, only if he is compensated for a desirable amount of return. We have risk lover, risk neutral, and risk averse. There are three types of investors: risk lover, risk neutral, and risk averse. The risk lover uh, is the investor who love to take risk, or rather, he would be investing in only in those securities which have got risk. Risk neutral is going to invest in only those securities which are having a greater amount of return without giving any consideration for the risk. And risk averse is the person who is said to be a rational. Rather, I can say this person, risk averse investor, is a rational person. This one is a rational guy because he is going to invest in the security only if he is going to be compensated with a desirable amount of, only if he is going to be compensated by the desirable amount of the return. Okay. Now, Harry Markowitz said that an investor will enter the market in order to attain utility. So he came up with a formula for measuring the investor's utility. Now, investor's utility, he said that investor gets happiness or utility when he see the return in the security or when he's expecting certain return in the security. And of course, his utility level or happiness level reduces whenever he perceives any risk. So that is going to be like half into aversion factor into variance. Investor's utility is going to be expected return minus half into aversion factor into variance, because this is simply going to tell you uh, investor's utility. This is going to tell you what is the net utility that the investor is expecting. The net, what's the level of utility that the investor is expecting, right? And when we just put it into the graph as to what is the rate of return that investor is expecting for a given level of risk, this when we are putting this investor's utility into graph, we get a curve like this. Okay, so we get this curve, which is investor's utility. This particular curve is like, for a given level of risk, what is the return that the investor is expecting? So for a given level of risk, what's the return the investor is expecting? That's denoted by this investor's utility. And this utility is matched against the efficiency frontier that we see in the market. And this portfolio X, which is a point of tangency between the utility and efficiency frontier, that is what is considered to be the uh, portfolio which will be offered to the investor. So this is like the initial portfolio theory which was set by Markowitz, which was a guiding principle as to how to decide which portfolio should be offered to the investor. So for that, first we look at what is available in the market. And secondly, we just plot it on the efficiency frontier. Uh, and then we see what is the expected return of the investor based on its utility. And then we just map both of them and look for the tangent portfolio so that we can offer it to the investor. Okay, so that's the Markowitz portfolio theory. After that, we came up with a unique way of identifying a shortfall in this particular formula. So the shortfall was like this entire Markowitz theory considered only investment in the risky securities. It didn't consider what would be the possibilities of uh, what could be the possibilities of risk-free investing. When we bring that concept, we actually come with a new thing called as capital allocation line. And of course, after that, we also have capital market line. Okay. Let us see what is this capital allocation line and capital market line now. Now, Markowitz said that we have this efficiency frontier. But what if I tell you, so there's a possibility of risk-free investment also, and this is the risk-free investment we are getting. There's a possibility of risk-free investment, and this is the risk-free investment that we are getting. Okay. So now this risk-free investment that we are going to get can now be actually combined with this efficient portfolio frontier or efficiency frontier and create a different combination. So let's say you decide to combine risk-free with this portfolio named as A on the efficiency frontier. Now, if you're combining risk-free with A, you actually get a curve or you actually get a straight line like this, which indicates like if I invested fully in risk-free, you're sitting over here. And if I invested fully in A, then you're sitting over here. And somewhere in between, if you're sitting somewhere in between, then it comes over here. Maybe you have 50% of risk-free and 50% of A. So you're essentially sitting over here. So risk-free and A, you're sitting over here. Then if you just keep on combining both risk-free and A, so if you're shifted towards this side, you'll have greater proportion of risk-free security. If you're sitting on this side, then you are having a greater proportion of security A. Same way, you'll simply try to create different combinations. And then what you will see is possibility of always keeping the possibility, you see over here. Can you see the curve getting formed across the efficiency frontier? And as you keep on selecting higher securities, the line keeps on rising up to a certain point, or I can say up to the point of tangency. Right? So this particular line is a combination of risk-free security plus the security at point of tangency. And this new line, which you create by combining risk-free and the security at the point of tangency, is what we call it as a capital allocation line. This is what we call it as capital allocation line. Risk-free plus the tangency is what we call it as the capital allocation line. So risk-free security plus the security at the point of tangency. That's risk-free plus point of tangency. That's going to be capital allocation line. Okay, so capital allocation line, risk-free plus point of tangency, you can see the capital allocation line that we get. And this is obviously better than the efficiency frontier. Because anyone who is sitting over here at A, he would definitely be shifting to a position over here because this point is going to provide you a higher return at the same level of risk. So what we observe is all the investors, who are sitting over here, they'll simply shift to this risk-free and tangency portfolio. And ultimately, what we are going to observe in the market is that there's not going to be any efficiency frontier. Rather, what we will find is just a straight line, right? Which will combine, which will be having the combined effect of risk-free security plus the market portfolio. The risk-free security plus the market portfolio because entire market is over here now. All the securities are shifted to the upper side. Entire market is over here. And therefore, this is going to be called as now capital. And we have seen that this capital market line has got a equation which is like a return of our portfolio will be risk-free plus beta. No, don't have the beta over here right now. So it's going to be risk-free plus RM minus RF divided by standard deviation of market into standard deviation of security or the standard deviation of portfolio. This is what is the capital market line. And mind you, this is not your capital asset pricing model or beta. Okay. Beta comes a stage after this. Beta comes in the next stage. What is that uh, capital market line, which actually leads to formation of securities market line? Let's go for the next discussion, which is the securities market line. Yeah. The securities market line is based on underlying concept, and that concept is like based on the number of security, what will happen to the risk of security, risk of the portfolio. On one side, we have number of securities, then we have the risk. What do you feel, guys? What will happen to the risk of our portfolio if we increase the number of securities? If you are going to increase the number of securities, if you include more and more securities in your portfolio, what's going to happen to your portfolio risk? What's going to happen to your portfolio risk? Yes, risk will reduce with the increase in the number of securities. Okay. So do you mean to say that the risk will be reduced to zero? You mean to say that the risk will be reduced to zero? Yeah. Will the risk reduce to zero with the number of securities keep on increasing? No. So risk of security will keep on reducing, but only up to a point. Beyond that, you have to accept certain amount of risk, right? So this risk which you are able to reduce is what we call it as unsystematic risk. And the risk which you are able to reduce or which you are not able to reduce is called as the systematic risk. It's called as a systematic risk. And a combined effect of all of that is called as the total risk. So you attain whatever level of diversification, still you have to accept certain degree of risk. Right? So whatever be the level of diversification in your portfolio, you have to accept certain degrees of risk. And that risk is called as a systematic risk. You can't do away with that amount of risk. Okay? You can't be doing away with that amount of risk. And therefore, we say that systematic risk is going to be something which you have to accept in your portfolio. Okay. Now, the risk that we are definitely going to undertake is called as a systematic risk. And therefore, this securities market or securities market line is going to tell us something about the return that an investor would accept. Now, whatever be the level of securities, whatever be the number of securities, you are definitely going to uh, have, you're definitely going to have certain number of, a certain amount of systematic risk which you have to bear with it. And therefore, now the securities market line says that all the investors are supposed to be rational. And since they are rational, they can't be asking for a higher level of risk, a higher level of return. They will be obviously asking for the return that should be compensating the systematic risk. Because any rational investor would definitely go ahead with the diversification, right? They will be creating a portfolio of securities which are well diversified. Okay? And therefore, they should be asking for the systematic risk premium and not the total risk premium. And that itself, it says that your capital market line was risk-free plus standard deviation of security upon standard deviation of market into RM minus RF. Okay. But then securities market line, it says it will be risk-free plus standard deviation of security upon standard deviation of market adjusted for correlation between security and market. Because we say you can't be asking the risk premium for the total risk, rather, you should be asking for only that portion of risk which is related to the market. Market means overall system, right? And this term, we call this term as, what is this term called as? Combined term. Can we write this term as? Yeah, that is what we call it as the beta. That's beta into Rm minus Rf. Or I can say over here beta is a measure of systematic risk. Beta is a measure of systematic risk or the market risk, you can say. And we can calculate this beta by calculating standard deviation of security into correlation between securities and market on standard deviation of market. Or we can calculate it by some other means also, which is covariance between securities and market upon standard deviation of market square or variance of market, you can say. Okay. Then we can also calculate this as summation of S minus S bar M minus M bar upon summation of M minus M bar square. Okay, so these are the measures of calculating the beta. One more concept which we have is equity beta and asset beta. So equity beta is this equity beta. What is this? This is systematic risk for equity shareholders. And this one is systematic risk for all assets. Of course, out of these two numbers, what do you feel? Which beta is going to be a larger term? Out of these two numbers, equity beta and asset beta, what do you feel? Which one is going to be a larger term? Asset beta or equity beta? It's going to be equity beta because it's going to be equity beta because assets are going to pose some risk, but equity shareholders are going to take a greater amount of risk for a simple reason. You can say on one side you have asset, and on the other side you have like finances, which is equity and debt. Asset beta is giving you this number as risk, which is asset beta. But then what about the beta for the debt? They are not taking any risk, right? So For smaller amount of investment, equity shareholders are taking a greater risk, right? Even though you can say, let's say assets are worth 100, equity shareholders are having 30 and debt is having 70 value. So the risk of that 100 is borne by this 30 investment by the equity shareholders. Risk of 100 is undertaken by uh, equity shareholders are having their investment only to the extent of 30. Of course, the risk that the equity shareholders are undertaking is a bit higher number as compared to the overall asset beta. Okay. We have a formula for this equity beta. Equity beta is calculated as asset beta multiplied by debt into 1 minus T plus equity divided by equity. Now, the logical explanation is simple. Asset beta is for this entire term, right? So this magnifies our total as beta. And then you just simply divide it by only the equity shareholders, which is going to tell you the risk undertaken by the equity shareholder for every rupee of their. Okay. That's your equity beta and asset beta relation. So that's about the securities market line, which is RF plus beta into RM minus RF. Then we have another formula or another model, which was characteristic market line. Characteristic market line. Characteristic market line is simply looking for the return that investor would be expecting. It will be or the security return will be calculated as beta into market return plus alpha. So this is based on the regression theory, where you have this particular term called as the intercept, and beta is going to be the slope. So over here, what we are trying is we are trying to create a line from the scatter plot. You have market on one side and the security on the other side. You have the various combination of market and security returns that are generated, and then you create a straight line out of it. You create a straight line out of it. And this particular line is what we call it as return of security is beta into market plus alpha. Okay. So this is the characteristic market line where we try to draw a straight line using the regression concept. But this line is also relevant because this helps us. Not visible. I think it should be. There should be some technical issue on your side, Oma. I think you have zoomed in or something like that. Therefore, you won't be able to see. Okay, so video is in that format. My bad. So we see that this securities market line is going to be like the line which goes to exactly through the scatter plot between the returns of market and the security. And that's based on the regression concept where you have alpha as an intercept term and beta as a slope term. Okay. So this also has got a significance. So now we need to obviously check how do we calculate this beta. Beta, like normally it is calculated, but how do we get this alpha? This alpha formula to get alpha over here is return of market, or I can say average return of market minus beta into average return of market. It's average return of the security. Average return of the security minus beta into average return of the market. Okay, so this is your alpha. If you have, let's say, security and market return available with you, market and security return available with you, what you are going to do is simply first calculate beta. Okay. Beta will be calculated as what? N summation of security into market minus summation S into summation M whole divided by N summation M square minus summation M the whole square. You have market and you have securities. So you need to calculate what? S into M and M square. You just need to take the total values, substitute in this, and get beta. Just substitute the values over here and you get the value of beta. Uh, Now this beta, you just need to substitute over here to get the value of beta. And then of course you calculate the alpha value by simply taking S bar minus beta into M bar. So that gives you the value of beta and alpha and your equation is ready. Now let's say, for example, you get beta as 1.2 and let's say, for example, you get alpha as 4. Of course, we have the security return now as 1.2 into market plus 4. This is your characteristic market line. Whenever you want to calculate the expected return for a given level of market return, you just need to substitute in this. You need to substitute in this market M certain value, you get the value of security. This is not what is intended out of this model. This model has got a greater degree of significance when we want to classify the risk into systematic and unsystematic risk. So let's have a look at that. Since we have security as beta into market plus alpha, now we can apply variance. When we're going to apply variance, it becomes like variance of security will be beta square into variance of market plus variance of alpha. Plus, there's going to be some error term also because you see the line is not touching all the points. There is always certain gap that you see. So the gap that you see between the point and the line, right? All of them are nothing but the error terms. If you want to see what is the expected return, right? You want to see what is the expected return, then it is beta into market plus alpha. But when you want the actual security return, I need to include the error term in this also, right? And this error term is also going to be considered in the variance. Now, of course, when you're looking at calculating the variance of alpha, when you're looking at calculating the variance of alpha, this one, variance of alpha, what do we this call it as? What are we going to call this as? Variance of alpha. What is this term going to be? Of course, 0, because alpha is a constant term. If I tell you, let's say alpha is 4, there is no variance possible in that, right? And therefore, we have this formula coming out to be variance of security is equal to beta square into variance of market plus variance of error term. This is your total risk. This is denoting the systematic risk, and whatever is left out is called as the unsystematic risk. Okay, so we have total risk, systematic risk, and the unsystematic risk. Okay, fine. So that's the application of this characteristic market line, uh, wherein if you have the value of beta and the variance of market, and you have got the variance of security, which is total risk, you can actually calculate the unsystematic risk portion also. Okay. Now, after this model, uh, then the question arises, sir, I can calculate the variance of security by using this by using this characteristic market line as variance of security. You are saying it's beta square into variance of market plus variance of the error term. But on the other hand, you also had variance of security using the Markowitz formula, which was weight of x square into standard deviation of x square plus weight of y square into standard deviation of y square plus 2 into weight of x, weight of y, plus 2 into weight of x, weight of y, standard deviation of x, standard deviation of y, and correlation between x and y. So you have two set of financial economists now providing you formula for variance of portfolio. Okay. And we have observed in our regular sessions that when we are going to equate both of them, when we simply equate both of them, then we get a novel formula for beta. And we get a new formula for beta also. So the beta comes out to be like, or sorry, it was for the portfolio. This is for the portfolio. And then we say the beta of our portfolio, when you just apply this beta of our portfolio, uh, and we use this formula and equate both of them, we use the formula for beta as covariance upon variance and other aspects, right? You actually come up with a different values, which may not be, easily derived or easily looked upon. But yes, this beta values can be, when you just simply equate both of them, you get something new. So this terms, again, standard deviation of x and standard deviation of y will be further expanded into, we say, their systematic and unsystematic portion, right? And then you arrive at a totally different number. So let me just show you what is that expression coming out to be, because I don't want to uh, use the time for deriving that. I'll just rather show you how is that work coming out to be. Yeah, so you see this particular part, uh, beta of our portfolio. You can see the beta of portfolio. I can apply this sharp formula, and we can observe that portfolio, Sharp's portfolio risk can also be computed. This first portion This one is indicating your portfolio beta, right? And this is indicating the unsystematic risk. Okay. We have discussed this in detail in our regular session. I just wanted to give a recall to you. Now, after this theory of arbitrage price, after this theory of characteristic market line, then we have the last one, which is called as the arbitrage pricing theory. So, arbitrage pricing theory, this is an advancement over the capital asset pricing model, because capital asset pricing model uh, is telling us the capital asset pricing model CAPM is telling us that we should be asking for a return. We should be asking for like return of security should be RF plus beta into RM minus RF. This is as per the CAPM, right? But this APT model says that there is a problem over here. What's the problem? Uh, Problem is simple. It says that your capital asset pricing model considers just beta as one of the factor which is causing the risk in the security. But is it truly that case? Is it that the entire market is the source of risk? The movement in the market, the movement in the Sensex or Nifty, is it really the source of risk? No, that's not the source of risk. In fact, what is causing that movement is essentially a source of risk. So what causes the movement in market? Yeah, tell me guys. What causes the movement in the market? Yes, government policies, inflation, many other aspects are right. So arbitrage pricing theory says it's not going to be your market which is a source of risk. Rather, it's going to be multiple factors which is going to having a which are going to have an effect on the securities. Right? So rather we can say what you see in beta or volatility in the market, that's ultimately because of movement happening. That's ultimately because of the movement happening across the uh, market. That's the movement. The movement is happening because of the uh, things happening in the overall market, multiple factors. So all effects like government policies, inflation, supply chain issues, or forex reserves, all those in totality are going to have an effect on the movement of the market. It's wrong to say that all the factors are going to have a similar impact. And therefore, arbitrage pricing theory says that the return of security should be definitely lambda zero, because lambda zero is your risk-free security. But you need to look for the various sources of risk and add a risk premium fee based on that. It's going to be lambda zero plus beta 1 lambda 1, beta 2 lambda 2. Like this, it goes on till beta n lambda n, where we say beta 1, beta 2, beta 3. These all are what? Beta 1, beta 2, beta 3. All of them are what? Factor betas. We can say factor betas means these are the risk measures of various factors. What could be the factors? Factors could be your inflation, your GDP growth rate. It could be the level of unemployment. It could be the level of forex reserve. So multiple such factors can have this impact. Okay. So that's your beta 1, beta 2, beta 3. And then you have like lambda 1, lambda 2, lambda 3. So these are simply your factor risk premiums. These are the factor risk premiums. Lambda 1, lambda 2, lambda 3. These are the factor risk premiums. Okay. So this model is going to capture the risk coming from the various sources. After this model, we had certain concepts to measure the portfolio performance, right? So portfolio performance measures, we can measure the portfolio performance by looking at their risk and return numbers. One portfolio performance measure was called as the Sharpe ratio. And this Sharpe ratio was simply looking at what is the risk premium, which is return of portfolio minus the risk-free security. What is the risk premium that you are providing for every unit of the total risk that you are undertaking? Then you have trainer ratio, which was again on the similar lines. Trainer ratio is return of portfolio minus risk-free divided by beta, which is a measure of systematic risk. Okay. And the last one was about Jensen's alpha. Jensen's alpha is a return of portfolio minus the return which you would get under CAPM. So it is return of portfolio minus risk-free plus beta into RM minus RF. That's your Jensen's alpha. Okay, so that's your Jensen's alpha, return of portfolio minus risk-free plus beta into RM minus RF. Okay, got it. So that's the revision part. So we have compared, we've did all the theories that we have in the portfolio management. Now let's take up the assignment questions for discussion. Just share the assignment question. Okay. So we have this first question for us. Okay, question number one. Just have a look at this question, guys. Just give me a minute. Just read this question. I'll be back in I think question is read by you all. So Mr. Y is a portfolio manager which is going to manage an equity portfolio worth 40 lakhs. He's going to invest the funds in two stocks, Gamma and Delta, in the ratio of 70 is to 30. The daily standard deviation of returns is as follows, which is Gamma 1.5% and Delta of 0.8%. Okay, so for the first stock Gamma, it's 1.5% daily standard deviation, and for Delta, it is 1.8%. The correlation coefficient between those two stocks is 0.45, and we want to estimate, let's say, 1 day value at risk of each stock, as well as the overall portfolio at 95% and 99% confidence levels. So we have the mean daily return to be 0. Number of trading days, you have to take it as 252 days. And Z value at 95% interval is 1.65, and at 99% interval, you have to take it as 2.33. To calculate 1 day VAR at 95%, 99% confidence, 1 day VAR for Delta at 95 and 99% confidence, daily standard deviation of portfolio needs to be computed, and calculate 1 day portfolio value at risk at 95% and 99% confidence level. Determine the diversification benefits at both confidence intervals by comparing the portfolio VAR with the sum of individual stock VARs. And now suppose the correlations fall from 0.45 to zero point 0.1. We have to recalculate the portfolio VAR and diversification benefit. And we have to also see how the change in correlation is affecting the portfolio risk and diversification benefit. So let's do it one by one. Okay. First up, we have the portfolio value of 40 lakh, right? And we have the investment in Gamma and investment Delta to be given at 70 and 30%. So we can see that portfolio value is 40 lakhs, right? And we want to know what's the value at risk in Gamma and Delta individually. So I need the investment value in them also. So investment in Gamma is going to be 40 lakhs into 70%, which is 28 lakhs. And then we have investment in Delta, which is 40 lakhs into 30%. That's equal to 12 lakh. Okay. Now, standard deviation of Gamma is 1.5%. Standard deviation of Delta is 0.8%, which is per day. These numbers are per day. Then we have correlation between Gamma and Delta as 0.45 years. Correlation is 0.45. Okay. Mean return is anyways given to us to be 0, and Z values are also given to us. Now let us say first one, 1 day VAR of individual stock. say 1 day var or value at risk. So 1 day value at risk. The formula is Z value into standard deviation into investment value. Okay. So this is our formula. Of course, this standard deviation is also per day. So for gamma, 1 day value at risk, gamma, 1 day value at risk is going to be Z score. Now that depends on like what percentage we are seeking for. Let's say initially we are talking of 95% gamma 1 day var, or I can say gamma for 95%, gamma 95% 1 day var will be Z score. Z score for 95% is 1.65. That's 1.65 into standard deviation is 1.5% into investment is 28 lakhs. So how much is this number? Yeah. How much is this number, guys? 1.65 into 1.5% into 28 lakhs. That will be the value at risk for 95 day 95% 1 day var. This is what 69,300. Okay. Same way. Uh, Tell me what is gamma's 99% 1 day value at risk. Now 99% that score is 2.33. So this is 2.33 into 1.5% into 28 lakhs. What is this number? 97,860. Is 97,860. This is the value at risk, or we can say this is the value at risk. What do you mean by this value at risk, guys? Value at risk means the money which is at stake. When you say money which is at stake, it simply means this is the maximum loss that you can make with 95% surety in any particular day. On any particular day, with 95% surety, you can be sure that the loss cannot exceed 69,300. And with 99% surety, you can say it cannot exceed 97,860. Now, similar lines, can you calculate the value at risk for delta? Can you calculate the value at risk for delta, guys? You have all the information. You have the investment over here. You have the standard deviation of delta, right? And we also have the Z score. So can we calculate it for stock delta? Yes. Can we calculate it for stock delta? Let's go ahead, guys. Give me the numbers. Value at risk for the stock delta with 95% and with 99%. Yeah. Give me these numbers. So at 95%, it should be 15,840. And at 99%, it will be 22,368. Yes. Perfect. We are done with this one, this one. Now we have to look for calculate the daily standard deviation of the portfolio. Now, daily standard deviation of portfolio. For that, we'll have to apply the formula of Markowitz. Standard deviation of portfolio will be square root of rate of gamma square into standard deviation of gamma square plus weight of delta square into standard deviation of delta square plus 2 into weight of gamma into weight of delta. Standard deviation of gamma, standard deviation of delta, and then correlation between gamma and delta. Okay. So I think we have got the numbers for this. Yes. Weightages are like 0.7, 0.3, right? 0.7, 0.3. Standard deviation is 1.5, 0.8. And we have the correlation. So can you calculate the standard deviation of portfolio? Yeah. So we have to just substitute like the weight of gamma is what? 70%. So I'll just substitute the numbers here. Weight of gamma is 0.7. 0.7 square into standard deviation of gamma is 1.5%. 1.5 square plus zero point 0.3 square into 0.8 square plus 2 into 0.7 into 0.3 into 1.5 into 0.8 into correlation is 0.45. So if we solve this, what is a portfolio standard deviation? Portfolio standard deviation in percentage terms. Yes, 0.12, 1.78. Okay, let me make it up to four decimals. It should be 1.177 continuous. Yeah, 1.777%. Okay. Now we have the portfolio standard deviation and we know the portfolio value. Portfolio value is what? 40 lakhs. So what will be portfolio VAR? Portfolio value at risk. Now, of course, it depends on the percentage that you're saying. So we'll say portfolio 95% value at risk. That will be 1.65 into 40 lakhs into 1.177%. So how much is the portfolio 95% VAR? 1.65 into 40 lakh into 1.1777. That's 77,724. Now, what is 77,728? It all depends on how much decimal you are taking. It's fine. 5 into 3 lakh into 21, 7 percentage. Yeah, that's 77,728. And what's the 99% VAR then? Portfolio 99% VAR. This is 2.33. Okay, so 99% VAR. How much is it? 2.33 into 40 lakhs into 1.1777%. Yes, that's 1 lakh 9,762. That's your portfolio risk or portfolio VAR. Okay. Prem Kumar is getting a standard deviation of portfolio as 1.435. 1.435, it's 0.7% into 1.5% in plus 0.3. You can just check. There is some calculation error, I suppose, Prem. Have you taken just the weighted average? Have you used the correlation part or not? Just check. I don't think you have used this part. Might have just taken a total of these two parts. Okay. Now, coming to the next part, we have done the daily standard deviations done. Calculate 1 day portfolio VAR is also done. Now we have to look at determine the diversification benefit of at both confidence interval by comparing the portfolio VAR with the sum of individual stock VARs. Okay, so let us say gamma, delta, sum, and portfolio. Okay, at 95%, we had the VAR of gamma as 69,300 and that of delta was 15,840. So if I just add them, it is 85,140. And we've got the portfolio VAR as 77,728. So the diversification benefit that we have, the difference between them, how much is it? 84,140 minus 85,140 minus 77,728. Yeah, 7,412 is the benefit that we have. Then at 99%, gamma it had 97,860 plus 22,368. And then the combined was 1,09,768. 1,09,762. 97,860 plus 22,368. That's totaling to 1,01,128. Then the difference is 109,762 minus 100,128. That's 9,634. 9,634. I think this is something wrong. 97,860 plus 22,368. Yeah, this is 1,20,228. And the diversification benefit is 1,20,228 minus 109,762, which is 10,466. These are the diversification benefits. Okay. Now they say, suppose the correlation decreases from 0.45 to 0.10. We have to recalculate the portfolio VAR and the diversification benefit. The entire activity, this entire exercise needs to be done, but only the correlation terms are going to change. Only the portfolio numbers are, portfolio standard deviations are going to change and rest all are going to remain same. And we have to calculate the diversification benefit. So this portion is going to repeat it. But with the revised correlation. The portfolio part and diversification is going to be there. Over here, this is going to be with a correlation of 0.1. So we can calculate the new portfolio standard deviation with 0.1 being the correlation. Okay. And then calculate the portfolio VAR and give me the benefit. Will you be able to do it, guys? Yes. Can we calculate the revised portfolio risk? Calculate the revised portfolio risk or the portfolio standard deviation and then the revised portfolio VAR. Then calculate the benefit out of it. Yeah, what's the portfolio standard deviation? At correlation of zero point 0.1, standard deviation of portfolio. How much is it? 1.1002 percentage. Okay. So with that revised risk, we can definitely calculate the revised portfolio VAR at 95%. That's what 72,613. And what's at 99%? VAR at 99%. So at 99%, it is 93,396. Is it? No. At 99%, how much is it? It's 2.33 into 40 lakh into 1.1002%. 2.33 to 40 lakhs into 1.1. Lakhs and 100 is 1,02,539. 2,539. Okay, 1,02,539. So now we have these portfolio numbers. So here we have 72,613, 1,02,539. So what is the benefit? 72,613 and 85,140. In first case, the benefit is 12,527. And in the second case, it's 17,689. Okay, so that's the portfolio diversification benefit. So that completes our first question. Comment on how the correlation affects the portfolio risk and diversification benefit. Of course, as the correlation reduces, the portfolio risk reduces, and also the diversification benefit increases. So we can say as the correlation increases, portfolio risk reduces, diversification benefit increases. Okay, fine. So with that, let's take a break now, guys. After break, we'll be doing this second question and the third question. Okay, let's take a break now, guys. You're there? You're there, everyone? Yes. So let us second question. Go for the second question. Ms. P is evaluating two securities, P and Q, using a two-factor arbitrage pricing theory model. Factor sensitivities and actual expected returns are given below. So you have the risk-free rate, risk premium for factor one at 6%, and risk premium for second factor is 3%. Okay. And then you have the security P and Q, beta factors, beta 1 and beta 2, and then you have the expected or actual return. Okay. Using a two-factor model, using a two-factor model or two-factor EPT model, you have to calculate the required return for security P and Q. Compare the required return with the actual or expected return. Determine which security is correctly priced, undervalued, or overvalued. And briefly justify your conclusion. So Miss Play is having 2,50,000 available to construct a long short portfolio by taking a long position in security P and a short position in security Q. Determine the amount to be invested in security P and amount to be sold short in security Q. The desired portfolio factor sensitivities are 1.55 and zero point 0.2. You have the portfolio amount to be invested. Now, the desired thing is you want the portfolio factor 1 to be 1.55 and portfolio beta for factor 2 is 0.2. Assume that long short positions together constitute the portfolio. Okay. Now, with this data, the first thing that we need to get is calculate the required return for P and Q. We have to calculate the required return for security P and security Q. Now, the required return will be, of course, risk-free plus beta into factor 1 premium plus second beta into factor 2 premium, and same way it applies for security Q. Okay, so let us go ahead with the calculation. Risk-free rate is 5%, and then we have the risk premium also, and then we have the factor betas also. Okay. Let me do the calculation here itself. So required return for P. required return for P is going to be risk-free rate of 5%. It is formula is what? Lambda 0 plus beta 1 lambda 1 plus beta 2 lambda 2. For P, it is going to be risk-free rate is 5% plus beta 1 is 1.4 into factor 1 premium is 6%. Second beta 2 is 0.6 and the factor premium is 3%. So what is the portfolio thing over here? What's the portfolio return? I mean, what's the return of P? Yeah, return of P is how much? 15.2%. Yes. And what about the security Q? For security Q, it's going to be 5% plus 0.9 into 6% plus 1.3 into 3%. So return for P and Q. P is 15.2. What's the return for Q? 14.3. Okay. So when I compare it with the expected return, it is 16.8 for P and that's 14.5 for Q. What can we say about the securities? Are they overvalued or undervalued? Are they overvalued or undervalued? Like for this situation, your required return is 15.2, but you expect 16.8. So this is definitely undervalued. 14.3 to 14.5. This is definitely again undervalued. 14.3% or 14.5%, that's undervalued. Okay. Now, next is second case we have. Mr. has 2,50,000 available to construct a long short portfolio by taking a long position in P and short position in Q. Okay. Uh, Determine the amount to be invested in P and the amount to be short sold in Q. And we want the portfolio beta to be 1.55 and zero point 0.2. Assume that the long short positions constitute the portfolio. So how do we get this particular part? We don't know the amount of investment. Okay. So now we want the portfolio beta to be 1.55 and the second beta to be 0.2. What is the amount that we need to invest in P and Q? Yeah. So we have to create a long short portfolio. It means we have to going to be long like in P and Q short in Q. So the amount of investment that we make in P and in Q net should be 2,50,000 because you are going to invest in P and we're going to short sell Q. So the net investment should be 2,50,000. But our desired beta for factor one, it is 1.55, right? So desired beta in factor one is 1.55. So how do we ensure that it is done? So we'll say 1.4 of P minus 0.9 of Q, right, should be equal to 1.55 times of 2,50,000. This P and Q are the amount of investment that are being made in both the things. So it is, then you have the second is 0.6 P minus 1.3 Q is equal to 0.2 into 2,50,000. So of course, the equation turns out to be 1.4Q P minus 0.9Q is equal to 3,87,506 P minus 1.3Q is equal to 50,000. That's second equation. Can we solve both the equations and get the answer? Solve both the equation, get the answer. Solve both the equation and get the value of P and Q, guys. And give me the value of P and Q. Yeah, what's the value of P and Q? Are you able to solve it? Solve them simultaneously. You can solve it simply by multiplying the respective equations with their LCM numbers. And you should be able to get the value. Okay, let me just quickly solve it for you then. Well, this multiply by 6 and Let me multiply this by 14 so that I'll be able to get the similar p coefficients. Right, and then you can solve it. So multiply this by 6. So 1.4 into 6, that's 8.4p minus 0.9 into 6, which is 5.4q is equal to 3,87,500 into 6 is 23,25,000. This is 0.6 into 14, which is 8.4p minus 0.3 into 14, 18.2 equal to 50,000 14. 7 lakh. And when you solve them simultaneously, you get the values as what? P and Q. What are the values for P and Q, guys? What are the values of P and Q? You just take this as an LCM, or this gets cancelled. So you have 18.2 minus 5.4, which is 12.6 Q is equal to 23 lakh 25,000 minus 7 lakh 16 lakh 25,000. The value of Q. The value of Q will be 16 lakh 25,000 divided by 12.6. This is what? 1,28,968. The value of Q. Then we can get the value of P also as 1,28,968 into 0.9 plus 3,87,500 and divide it by what it is, 3,58,000. 5.4 minus 18.2, 12.8. 18.2 plus 5.4. Oh, this is 12.8, my bad. Yeah, so since this is 12.8, this is going to be how much? 62,500 divided by 12.8. Yeah, 126,953. What about P? 387,500 and this divided by 1.4. How much is P value? 0.9 into 126,953 Add it to 387, 500 divided by 1.4. Yeah, so that's 3,58, 398. Okay, that's the value of P and Q. Okay, but then we have one more criteria wherein we say that the total of both should be equal to 2,50,000. Okay, but the problem is if you take a long short position and we constitute a portfolio value, uh, it's not consistent with what values we get. And that is exactly what is the problem with the okay, regarding that these two numbers are not consistent with the total investment that needs to be made, and that is exactly what we are having as a shortcoming of this arbitrage pricing theory model. This APT model, it's not going to be exactly accurate, or it may not, it may fail sometimes to create a portfolio targeted, for the targeted values of the beta. So that's the inherent problem or shortcoming of this particular model, which is arbitrage pricing model. Okay, so we can solve this equation, but it is not going to be consistent with that of the targeted portfolio betas. Okay, we may be able to solve it, but as I said, the answer may not match with your targeted amount of investment that you need to have. Okay, so after looking at that shortcoming, now let us have a look at this question number 3. The portfolio manager is evaluating, or I would like to you to go through this particular question once. Just take a couple of minutes and go through this question. For the ease of solving this, I'll just put it in the Excel format so that it's easy for us to do calculations. And also for presentation point of view, also it seems to be. So portfolio manager is evaluating 5 equity securities to construct an optimal risky portfolio using sharp single index model. Securities are listed on a well-developed stock exchange and satisfy the assumptions of capital asset pricing model. We have securities PQRST, expected return are given, beta values are given, and then residual variance is given. We have the additional information as risk-free rate is 5%, expected market return is 13%, market variance is 0.036, cutoff rate is given 7.2%. Now, what is the cutoff rate? We'll have a look at it. Then for each security, we have to compute ZI, the proportional investment in optimal portfolio, and then you have to use the KPM to look for which is undervalued, overvalued. Okay, so a lot of things we have to calculate. First, let me just put this data in an Excel file so that it helps us in. We have securities, the expected return, we have beta. There we have this as PQRST. So expected return are 18%, 16%, 14%, 12%, 10%. And the beta values are 1.5, 1.2, 1, 0.8, 0.5. Error terms are 0.0256, 0.02000. Then you have 0.0169, 0.0121, 0.00081. These are the error terms. Okay. Once we have these error terms available, now let us go for also taking the data as risk-free rate is given as 5%. We have the here risk-free rate is 5%. We have market turn as 13%. Market variance. Variance of market is 0.036. And cutoff rate or C star. We have the C star value, cutoff rate as 7.2. Now, the first thing is using sharp single error, calculate the excess return to beta ratio. So we need to first compute the excess return to beta ratio. And based on the given cutoff rate, identify the securities that will be included. Okay. So first we need to get the excess return to beta. So excess return to beta is simply going to be the expected return minus risk-free divided by beta. So this is expected return minus the risk-free divided by beta. So this is simply going to be the excess return, which is expected return minus the risk-free rate of 5% divided by the beta term. So these are the excess return to beta numbers. Okay. divided by the this is going to be multiplied by excess return to beta minus the C star value. So your ZI is going to be computed by this formula, beta upon error term, which is beta is the systematic risk, systematic upon unsystematic risk into whatever is the excess over the cutoff rate, whatever is the excess over cutoff rate. So we are going to compute the ZI over here. So ZI will be beta divided by error term into excess return to beta minus C star of 7.2. Okay. Okay. So that's your ZI first value. These are the ZI values. The ZI values are obtained by multiplying systematic to unsystematic risk into excess return to beta over the cutoff rate. We have got these ZI values for all the terms. Now, portfolio weightage will be simply you take the summation of all the ZI values and then you take the weightage as this divided by their summation. These are the weightages based on ZI values. So based on ZI values, we have these weights. This is a sharp model in which it identifies first the set of securities to be taken, and then we calculate the weights. Okay. ZI values, what denotes? ZI values are denoting, this excess return to beta minus cutoff. This is the additional return that you're getting over and above the cutoff. You adjust it for systematic and unsystematic risk. Okay. 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 Are we done? So these are the weights that we have. Okay. Now, the first part is done. You got the proportion. Present the final portfolio weights as percentages. Okay. We can present these simply as percentage. Okay. The next part is use CAPM. Calculate the required return on each security. Compare the required return with the expected return and state whether it is undervalued or overvalued. Simple. You can get the CAPM return as risk-free return 5% plus beta into 9.6, 13, 11.4 and 9%. And then we'll say whether it is undervalued or overvalued. So if you compare expected return with CAPM return, so is it undervalued or overvalued? Yeah. So expected return is 18, your required return is 17. It is obviously undervalued, right? Then second one again, higher expected returns. So you can see all of them are definitely undervalued. Okay. Now state whether each security is undervalued or overvalued, fair value. That is done. Briefly explain why sharp single index model are using beta. So market movements are represented by the sharp single index, which is beta. Total risk is definitely considered as systematic and unsystematic. Diversification is eliminating that part. Right now, what is going to be the effect of the last one, which is discuss without recalculating the entire portfolio? If the market variance increases from 0.036 to 0.049. So if the market variance increases from 0.036 to 0.049, what's going to happen? If the market variance is increasing from 0.036 to 0.049, in our entire process, what's going to be happening with this? First, let's discuss about what will be your cutoff rate. Is the cutoff rate going to be higher or lower? Because if the market variance increases, okay, so first we'll say market variance increases, that will lead to what? If the market variance increases, what is going to happen? If the market variance increases, what is going to happen? What risk is going to change? If the market variance increases, systematic risk increases or unsystematic risk increases? Yes, if the market variance increases, can I say systematic risk increases, right? If the systematic risk is going to increase, if the systematic risk is going to increase, so if the market variance increases, systematic risk is going to increase. Okay. And as the systematic risk is uh, going to increase, uh, the exposure, the risk premium which you're going to get is also going to increase. So excess return is going to fall. So when the market variance increases, the systematic risk increases. right? And due to that, uh, it reduces the attractiveness. It reduces the attractiveness to take additional systematic risk, because already your market is having a good amount of higher systematic risk. So you won't be, you won't find it lucrative to take additional systematic risk, right? And therefore, that will further reduce the C star, or uh, the cutoff rate is going to decrease. Okay. So this is going to reduce your cutoff rate. Then second part is whether the composition of optimal portfolio is likely to change. Is the composition of optimal portfolio likely to change? Is the composition of optimal portfolio likely to change? So a lower cutoff rate, if your cutoff rate reduces, right, generally allows more securities to qualify for inclusion, since all five securities are like in our case, all five securities are included because cutoff rate has reduced. Your cutoff rate has reduced. But in our case, since all portfolios are selected, since all securities are selected, lower C star will not cause any change in composition, as all securities are selected. Since we are selecting all the securities over here, then even if your C star reduces, it's not going to have any impact on the composition. But weightage of securities will change. Weightage of the securities is definitely going to change. Okay, so weightage of securities is definitely going to change, because since in our example, all the numbers were having the excess return to beta values in excess of this C star 7.2, right? In excess of this C star 7.2, all of them were included in our portfolio. So even if your ZI value or the your cutoff value is getting reduced, there's not going to be change in the composition, but definitely the weightage is going to change, because as we said, the weightage is based on the ZI number, and ZI is going to be, getting impacted by the C star, and therefore these ZI values are going to change and weights are also going to change. Then the impact on systematic and unsystematic risk. What will be the impact of increase in market variance on systematic and unsystematic? So, as we discussed already over here, systematic risk is going to increase, right? And unsystematic risk is not going to change, because that is anyways going to be related to the individual securities, right? So, as we discussed, systematic risk will increase. Systematic risk will increase. Okay, because as we have already discussed, market variance increases, systematic risk is increasing. What about the unsystematic risks? That will have no change, because that is very much specific to an individual security. And total risk definitely is going to increase, because your systematic risk has increased. Unsystematic is remaining change. Due to that increase in systematic risk, your overall portfolio is also going to increase. Overall portfolio risk is going to increase. Okay. I think that completes our third question. Yes, this was quite a technical uh, question, especially based on the sharp single index portfolio optimization model. Okay, so only one part which we need to look at over here is how to compute this ZI. Only that needs to be understood. Rest, everything can be easily understood. So you have this. First, you need to calculate the excess return to beta number, or you can actually call this. This is nothing but your trainer ratio. Right? So the first part is to calculate the trainer ratio, and that trainer ratio will be mapped against a cutoff value C star. So any security with Trenor ratio more than the cutoff ratio, that will be included in our portfolio, right? And those securities will be used to calculate ZI and then weights. Okay, so that completes this. That completes our question number 3. And with that, we are through with our revision for this portfolio management topic.
Thank you, Jagbandu sir. There is one student, that is Sucheta Joshi. Sir, she has sent some queries. Have you taken all the same?
Yeah, I've taken a quiz.
Okay. So, student, with this we come to the end. Jagbandu sir, from your side, it is over now.
Yeah, it's over.
Okay, student, now with this we come to the end of this first lecture of live virtual revisionary classes, that is targeting November 2026 examination for the paper Advanced Financial Management. Now, student, as this is a kind of a revisionary session. Now, in the beginning, Jagbandhu sir has started with the basically very simple logic. That is, what is the basic aspects, or what are the basic nut bolts of the portfolio management. And he has started with the expected return, then standard deviation, then portfolio return, then portfolio standard deviation. And then he moved to capital allocation, then Markowitz frontier, then capital allocation, then capital market line, then security market line. And after that, he has very beautifully linked it with the market return, that is Sharpe index model, that is market based return, and through the characteristic line. We can say the characteristic line is regression, is based on the regression through the market return. So now, and after that, he is very, I can say it is very, very beautiful manner. He has linked it with the asset beta, which is also a part of the your topic number chapter on the business transaction, where it is covered. So he has initially covered very briefly and in a very lucid manner the basics of the portfolio management that you have covered in your regular classes. So Jagbandu sir, am I on a right track that you have started with the in the same manner?
Yeah, sure.
Yeah. So now Jagbandu sir has taken 3 questions. Now, due to some technical problem, the assignment could not have been uploaded despite our all efforts. I think it by today it will be completed. Now, the purpose of taking this kind of now you will find that this time 3 questions are more elaborative than our previous questions. Now, this exercise has been done mainly to keeping in view the recent question paper that has appeared in the this is question paper in May 2026 examination, where the application of the related concept have been asked in a more elaborative manner. And not only that, even two or more concepts have been asked in a one question. So on that line, Jagbandu sir has framed the question, that is where the value at risk has been covered. So that you could it is clear to you how we can solve a question that involves to one or more than one concept, or two more than two concepts in any questions. So student, I think the session was very interactive, and if you have any query, you can Jagbandu sir just share our email ID so that this code. So whenever you contact, just just 0120 is our STD code. So student, thank you very much. Precious time and enlightening the student on this topic. So student, we shall continue more topic in the next class. So keep on revising the same topic and keep on learning. Thank you very much and have a nice day. Thank you, Jagbandu sir.
Thank you.
Have a nice day, sir. Okay.
Recording stopped.